Good afternoon and welcome everyone. On behalf of Chris, Dale and myself, the partners at Vivo and the rest of the team, thank you for your attendance and welcome. Just a few housekeeping measures. If you could please keep your computer on mute. Unless you're asking a question later on, unmute and then mute afterwards, just to avoid any background noise that might arrive. This is our Business Booster event. We aim to have these quarterly, and as part of our ongoing process of helping clients grow their business, we also live our value of education, both internally with our staff and externally with clients. We deliver education through our monthly service programs and through quarterly events such as this, which we hope bring value to you in doing so. We also appreciate your feedback, and if there's, we'll talk about at the end of this, but if there's also subject matters that may be of interest to you that you would like us to address, we would appreciate that feedback as well too. Today is all about forecasting and ensuring the success of your business. Now, it can be a little bit of a dry subject, some people might think, but this is really talking about the fundamentals and principles of forecasting. So the presenters today are Chris Morris and Dale Edwards, my two partners, and myself, and it'll be done in 3 stages. I think that you will get something out of it, and there may be some questions that arise in doing so. Because it is a staged event, we just ask that you can submit your questions on the way through, but we will answer all questions at the end just in case they're being answered in the subsequent stages. We do want this, though, to be as interactive as possible, so please come forth with your questions, but just keep your phone, your computer on mute in the meantime. Make sure your phones are muted as well. Got to do all this normal housekeeping stuff as well. As you can see on the screen, this is a general information only, so we're not talking specifics about anyone in particular and their financial information. So it is general information and not specific advice. It is not a tips and tricks style discussion as we've done in the last few. This is more principles and guiding overview towards forecasting. So without any further ado, we will kick off. I will speak first on the principles of forecasting. Chris will then come in and speak on the structure of forecast, how you structure it, the inputs, the X that you might need, and KPIs, etc. the important. And then Dale will join in and discuss some reality checks, some common omissions, and then how to make the living document that is your forecast visible and monitor your progress. Thank you very much. Okay, I'll kick off with forecasting principles. These are what we would call the guiding principles, I suppose, to preparing a forecast. A lot of these are things that you would consider before. And the first one is our one and only screen for today is on alignment. It is really important in business. We have a lot of other things, and things will come along that might distract you to say, I'll go off this, you might make some money, or you've got short-term goals and long-term goals. The main thing to remember is don't get distracted by all those other things. When you're preparing your forecast, it should align with your vision, your goals, what your business is all about, and stick to those. You may have along the way some short-term projects that you work on, but your overall budget or forecast should be aligned to the vision and mission of your purpose, which is a long-term. Your budget is a living and working document, and Dale will talk about this a little bit more, but it doesn't mean just because you prepared a budget, you don't go back and adjust it throughout the year, because monitoring it is absolutely important. And if you see something that's wrong, it's no good putting up false figures and doing that. So doesn't mean because you prepared a budget, you can't change it throughout the year. It's a living document, and it's most valuable if you are monitoring it and dealing with it, reviewing it every month. When you're preparing a forecast, there's a couple of different purposes for forecast. quite often forecasts might form part of a government grant application. They might be part of a finance application for your bank. You could be raising capital externally, looking for equity, and you would prepare one. So there's some, in those instances, you have external parties that will be looking at the document, and it may need a bit more detail. I probably prefer to do this in all instances. I believe that every time you prepare a forecast, you should make sure that you have documentary evidence or detailed explanation of the bases of every income and expense line in there. So if someone asks a question, you can answer that and you've got some facts to support it, or say, this is why we've come up with that, particularly when it's those third-party users. Because if you've got a third-party user and they have some doubts and they're asking questions, one simple question, one simple doubt raised may well affect the credibility of the document. So you want to make sure that you answer any questions before they're asked, and that you have the facts and figures to support every income and expense line in your budget. Another key thing to consider is that depending on the size of your team, but if you've got a reasonable sized workforce and a team of people, involve the people who have input into the section that relates to them. They probably have a better idea about some of the microscopic costs and income items or impacts that might affect their area. But involving them, you'll get their buy-in and long-term commitment to the budget. And ultimately, that's what we're trying to achieve. We want to achieve that budget. If you've got your team with alignment and buy-in, there's a much greater likelihood that they will support and work with you to achieve the budget going forward. Every budget, despite what we think at the beginning of the year when we're doing this, you need to build in some contingencies. And as an example, if you're doing a budget or a forecast for a property development from a bank, they will insist on something like 20% contingencies to be built in. So you might build it into individual income or expense lines. You might have a little bit of a buffer in there, or you'll build in just a contingency line at the end. But make sure you do allow for contingencies. Imagine if we would have gone into something like COVID and had no contingencies or something like that. The old saying, S ... happens, and you need to allow for it. So the other thing is also to consider, we all think that we know our business, we know our markets, but particularly when you've got third-party users who are going to be looking at the document, but it doesn't hurt just to get someone else's opinion or views. Think about what other supporting information may be available out there. There's, look at economic forecasts, look at, that'll affect interest rates or something else like that. You might be in a market that you can buy an IBIS World report that, talks about your market. There's, peak body reports or anything like that. Gather those up and use those and see what they're saying is going to happen in the future. Don't just go off with your own view, because we do tend to have little rose-coloured glasses on our face every now and then with our own businesses. So it's important to have some objectivity from third parties and what they think's going on as well factored in. Similar to that, probably little side note is to consider what's going on in legislation that might affect you. And in your business, you should be monitoring any sorts of legislation. Unfortunately, in our industry, there's too much of it and they interfere too much. So we have to be on top of it all the time. But depending on your business, just consider whether there's legislation effects that may affect you. Look, the main thing I said at the beginning was think long-term and be aligned to your goals. But, and it is really easy to, we get approached by people all the time in our business to, oh, what about this? What about that? And you can consider a new shining object that might be worthwhile, but quite often they're just distractions. You can have short-term budgets built into longer-term budgets where you've got a special project that might be new premises or something like that. But remember, align to the long-term goal, follow that, and keep to that, and keep aligned to your visions is probably the most important thing. And that's the reason why I'm covering that one off twice. most common mistake I have seen, though, with budgets is that most people, when they think of budgets, all they look at is a profit and loss. Realistically, when you're completing a budget, you need to look at your balance sheet and cash flow. And without being too much of an accountant, thinking about the most common problem is just because you raise an invoice and it appears in your profit and loss as income, it doesn't mean you've got cash in the bank to pay your wages and everything else like that. Or if your business is growing rapidly, you'll need more stock and your debtors are growing. They're all taking up cash. So we need to consider both balance sheet, profit and loss, not both, all three are balance sheet, profit and loss, and cash flow when doing a budget to make sure we cover it, particularly when you have a business that is undergoing some change or the market's moving or you're particularly growing. We focus on growing businesses. So therefore, I'd say it's most of our clients should be considering all three. At some point in considering all of those options, you're going to come up with, well, what other resources do I need or what barriers might pop up? So if your business is growing all the time, are you going to need more staff? Have you allowed for that? When do you need those staff? Are you going to need more premises? Are you going to need more machinery to produce what you do? Depending on your business, there are some significant hurdles. And unlike what we're seeing on that screenshot there of alignment, it's what we would call like a linear graph where it progressively goes up like that. Unfortunately, business and growth doesn't normally go like that. It's more a step thing like that. So those points are significant. And at some of those points, I know I'm going to need more premises. I'm going to need more storage space. I'm going to need a new machine because if I'm selling that much, I won't. And people often, when they consider their budgeting, they tend to just focus on how do I grow sales? How do I grow sales? How do I grow sales? Well, there's going to be those barriers that pop up that you need to consider. And as a business grows, another one that commonly gets overlooked is that the larger the business gets, the more complicated it gets. And you'll need greater documentation, understanding the complexity, more corporate governance, more systems and processes, so that people can do their role. You've got redundancy and all of that. So building in those systems and processes and corporate governance is another key factor that you would need to consider and allow time and cost for doing so when you are growing your business. And they do need to be built into your budgeting processes, the barriers. So ask yourself this question: what could get in the road? What are the barriers, or at what point will I need to do something different? Yeah? Will I need more cash? Will I need to go to the bank? Will I need more premises, more staff, more infrastructure? The last point I'm going to touch on before I hand over is, and it is what I call the glass point for a particular reason, is when you're forecasting, and generally we at least do 1 year, but if I do valuations, I need to be doing at least 5 plus a perpetuity. If you're looking longer term, you need to think about one other thing, and that's your exit strategy. Are you going to continue on in this business? Everyone's heard me say, start with the end in mind. But if you're going to think about the exit, what does the business need to look like for me to exit? Do I need, what staff needs to be there to cover my absence? Have we got all the redundancy? Have we got those systems and processes I talked about? So think about and make sure you build into the budget. You've got everything there that allows for an exit and that it looks like what it needs to do for an exit. And that might be, well, I think I need to have greater than $10 million sales. My net profit should be 25%, some of those sort of things. So you've got that goal in mind and the financial forecast is aligning to your vision of what you want to achieve. On that note, I will call it quits for me for the time being. I'll be back at the end to talk through the questions, and I'll hand over to Chris Morris.
Thank you, Leon. Afternoon, all. Leon, all very good points. They really are, and it just reiterates to me how much we're trying to squeeze into a small session. So I'll do my very best. I apologise if I speak quick. The topics which I'm covering off are costs, KPIs, lead and lagging indicators, some very briefly on some software options, then I'm going to throw to Dale to do a live example because he's the brave one amongst us all, because everyone loves live examples on technology. So first of all, costs. None of these will be a surprise to people, but I will just cover off on them very high level. Again, if there's any questions, we'll be around at the end, so please do sing out. Happy to answer or discuss anything. Just the different types of costs that will feature in your strategic forecasts. We've got fixed costs, which are commonly referred to as overheads, and they stay the same regardless of the level of sales or operations. We've got variable costs, which are your direct costs, often referred to as your cost of goods sold, and they will vary with your level of sales. They're directly related to the level of sales. Then there's a hybrid of the two, which are semi-variable costs. And these ones have both a fixed component and a variable component. So a typical example of this would be electricity for a manufacturer. They're always going to have that base level of electricity. When they ramp up sales and ramp up production, they're going to increase that semi-variable component of it. Again, doing costs very quickly, the final part of costs, worthwhile mentioning, Leon touched on it before, it's that additional expenditure that's required along the way. Now, often people will refer to a thing called sunk costs. And a sunk cost is typically something that, typically refers to a retrospective cost that can't be directly recovered. It can include things like marketing, sometimes CapEx. It can be implementing that new technology system. So it's important to understand those and where they get positioned along the forecast, which is exactly as what Leon was saying. Onto the KPI side of things. What I wanted to do was just quickly talk about some of the generic KPIs that absolutely will apply to all businesses. And I'll touch on a few more specific ones for different industries. But from a high level, whilst these KPIs are generic for all businesses, while you're setting them for yourself, so your target KPI will absolutely be specific to yours. So yes, benchmarking can provide an indication, but your individual differences will always play a part. And the first example I've got of that is gross profit, but we'll come to that in a moment. Also be aware that when I'm talking about these particular KPIs, they can be applied to the entire business as a whole. Like Leon said, you can have many forecasts inside a whole thing. So same thing for these KPIs. It can be applied to the entire business as a whole, a particular product, a particular geographic location, really any business segment that you're wanting to measure and get more information on. All right, let's go into it. Gross profit. Everybody knows what this one is. Total sales less direct costs, your cost of goods sold, equals the gross profit. Ideally, we want this to be as high as possible. The reason I say be aware of your own circumstances is the typical example, a client of mine actually in the, what would you call them? They're in the retail baked goods, shall we say. So there's good benchmarking as to what their gross profit should be. However, they actually also own the wholesaler. So their cost of goods would be considerably less than their competitors, and they've got themselves an advantage there that applies to them. So if they just apply the benchmarks and go, oh, well, we're doing okay against the benchmarks, no, they can do better because of their specific circumstances. So even though you may have some information, always make sure that you apply circumstances specific to you and your business setup. The next one is profitability. And again, these may seem like a bit of a no-brainer, but it's worthwhile mentioning because it's really important to have these on all of them. Profitability, if we look at it, obviously look at it from a whole business perspective, but if you look at it at a product level, profitability per product or profitability per segment, it can really shine a light on a segment which is underperforming or maybe underperforming. Or perhaps you've got a dog of a product in there which you shouldn't be stocking. And unless you're actually measuring that profitability per segment or per product, that dog could be hidden amongst the rest of your business data, and it could just be dragging your overall profitability down, and you've got no idea why, and you're trying to fix things, focusing on the wrong thing. So that's why I really like to have profitability percentage in there. The next one for me is your break-even point. And break-even, I see a few familiar faces on this, so you've probably heard me bang on about this many times, and I'm not going to make an apology for it. But break-even point is essentially that level of sales which is required to cover off both the fixed costs and the variable costs required to service that level of sales. I always take this a step further and work to a cash flow break-even, because like Leon said, people focusing purely on the P&L, the next step after that, that's great. We've covered the direct costs and the overheads associated with that. But what about the other cash flow side of things? Are there loan repayments that we need to make in that same period? Are there directors' dividends which get paid in that same period? So really make sure that you've got your cash flow side of things considered when you're looking at your cash flow break even. So that's why I go to that next level. The next one for me, and mindful of time, sorry, I will bump it along. The next one for me is the quick ratio. A lot of people would be familiar with the current ratio. It's essentially a better version of the current ratio. Current ratio is just a measure of liquidity of a business. So it gives you, it's a balance sheet ratio. It gives you an indication of a business's ability to pay its current liabilities as and when they're due. The difference between a quick ratio and a current ratio is the quick ratio excludes things that aren't easily convertible to cash. So, sorry, the ratio itself is essentially current assets divided by current liabilities. So very simple ratio, very easy to do. The quick ratio, when you look at your current assets, remove anything that's not easily convertible to cash. So that includes raw materials, it includes inventory, and it includes WIP, because all of those things will skew essentially what you're trying to achieve, which is a measure of your liquidity. The final broad KPI or financial KPI that I believe is really important is return on capital employed. And this is again another one, or ROCE, R-O-C-E. It's another one that I like to, force is such a strong word, but it's one that I like to force my clients to think about, because hands up those who would love to have a business with high profitability. I'd love to have a business with 50% profitability. Wouldn't that be great? Question is though, that's just a percentage of your sales turnover. That's not necessarily return on the capital that's required to achieve that. So you take that percentage, take those same amounts of dollars, and instead of applying it to your sales, take that as a percentage of the capital employed that's required to make those sales. And if that comes back, and it's highly possible it could come, I've got a couple of clients that are battling with this. If that comes back at say 1%, it forces the question, are you happy with a 1% return on the capital employed? If it's a pathway to a longer picture, that's fantastic. It just forces you to think about those wider questions. So that's why I really like that one. So those KPIs that I've spoken about there, they are really all lagging indicators, because they're all able to be determined from the financial statements. As long as your financials are up to date and correct, they're able to be determined from the financials. It's often those lagging indicators will tell a story of what lead indicators need to be focused on. When we talk lead indicators, they really are so specific to every business. There's the example which I'll use is the sales funnel. And I realize this particular example won't apply to some, but it does apply to most, and most can relate to it. And again, you've probably heard it before, but if we look at a sales funnel, it's a great example because you've got a level of activity up the top that once that activity is performed, it will result in X amount of qualified leads. And then those qualified leads result in how many conversions for the period, which will result in how many sales dollars for the period. So it all comes down the funnel. And that ultimately will reflect on your sales KPI that you've got in your P&L, but it's the activity that you're focusing on up the top here that's the lead indicator of the end result. So that's why lead KPIs are really important as well. I won't go into too many, but just very briefly, occupancy rate for childcare is a key one. If you're in the rental business, you've got asset utilization. Service, you've got resource utilization, staff utilization. There's far too many to list, but it really does depend on the business and well, also the way your business is set up as well. All right, mindful of the time, and before Dale brings the shepherd's crook out, I'll quickly touch onto the technology side of things. Technology for implementing your budget. Now, Leon mentioned that property developers have a need to have a very, very detailed forecast, and you can imagine however many projects over however many assets that they've got in the field or everything that they're working on. It is extremely detailed and it's amortized over time. There's software that they use to do that. There's a few different ones. One of the lead ones is Estate Master. Can be very expensive, all for a purpose. But my point is, there's the complicated ones are always too complicated, and the simple ones are often too simple. So it's really difficult to find something that will suit. If it's not a property developer that I'm dealing with, I like to try to keep things as simple as possible. Xero, for starters, they've got a feature called projects. So you can actually track projects in Xero. It's somewhat limited, but it does give you some functionality there. It's also got tracking categories, which comes at the base level. So you've got the ability to track different departments and locations, whatever you want there. So if there's something in particular that you want tracking, there's a good chance you can do it within your Xero as it's already set up. The other thing I did want to mention just briefly is I had a client they're a not-for-profit actually, and they've got not many, but they've got, say, 4 different projects that are happening at the one time that form the entirety of their operation. And they've got their overall budgets for those projects, and they're trying to track expenses against that particular project, but they want to see how it's going on the whole project. And every time they get to an end of a financial year, all their expenses disappear because it's rolled over in the software. And in their instance, we looked at a few different options to do it. The easiest solution for them was, yes, use the tracking categories in Xero, and then we'll just quickly do a spreadsheet outside of Xero. There's not, like I said, there's not that many that they're actually tracking. There's only about 8 different categories within their different projects. So it's a very simple solution, gives them the information that they need on where they're progressing with their budget, the actuals on each one of their projects. Very simple to do. Anyway, that's enough for me. Like I said, there's so many things we could talk about. I'll be around, well, we'll all be around at the end if there's questions, or if we run out of time for questions, shoot me an email, give me a phone call, whatever. I don't mind, happy to help or whatever we can do. Over to you, Dale. Thank you, everyone.
Thanks, Chris. Very insightful. Now, I get the unenviable job of doing a live demo, and Meredith, would you mind letting me have screen share capability, please? So one of the joys of this is that I'm doing a live demo in software. So if, to paraphrase the late, great Murray Walker, who commentated Formula One for many years, if something goes wrong, it probably will. Thanks, Meredith. So let me find my screen I want to share, which I think is screen 2. Great, here we are. So I'm going to do an example of doing a forecast. Now I'll narrow down the expectations a bit. This is on Xero, and it's only going to look at the profit and loss. So as Leon said, you don't just look at the profit and loss, you look at the balance sheet and the cash flow as well. But we've got limited time, and if we look at the balance sheet and the cash flow as well, we'd be here all day. So in Xero, I'm going to use the demo file. So to find that in Xero, you go to My Xero, which I'm in. You go right down to the bottom. I've got 6 pages of Xero files, so you probably don't have that many, but you go right down the bottom here, try the demo company. You can also reset that if you play around in it and want to get back to a clean version. So I'm going to reset the demo just so you all know that I haven't set this up beforehand and I'm doing it from scratch. So I'm into my demo company. So I'm going to look at setting a budget in Xero and then running reports on it to compare it budget versus actual. So the reality is you're going to spend more than 10 minutes setting up this exercise for your business, but I've only got 10 minutes. So I've got to do this really quick. So what I'm doing is I'm going up to accounting and the profit and loss. I'm going to use my last 12 months profit and loss as a comparative as a starting point rather to build my budget. So I'm going to use June 2023 and I'm going to compare it with the previous 11 periods. So this is going to show me month by month, June 2023 backwards, profit and loss. This is the demo file data. So Xero only have a bit of historic stuff there. So I'm going to dump that out to Xero, not to Xero, sorry, to Excel. And it's going to give me the, I'm going to need to drag that across from the other screen. The joys of sharing your laptop screen while you've got a 49-inch screen over to the right there. It's the challenge. So we've got our Excel showing, and if I don't, please shout. So this is what our Xero data shows for this dummy business. So we're going to say that we're going to build our real data out of this. So we're going to set some budget figures here. I am really just making this up as we go. I'm going to put some figures in here. One thing to look at when you are building your budget, so it's a lot more involved. Obviously, I'm copying and pasting random stuff at the moment just to do this quickly. But I find when I do this for Advivo, I actually go through each of the categories that we use in our costs especially, and go through the drill down into the transactions for the previous 12 months. And I actually look at them and see what's happened. And if there's stuff there that I don't understand, I drill down more and ask questions and find out why. And even for the things that are there, I will go into the invoices and look at the invoices and see what we're paying for and see if that's services that we need. Because sometimes you can go, yeah, I'm happy with using this provider and they do a good job for us, but you look at it and see what you're paying for and go, hold on, we're using all this extra stuff here that that we're paying for, but we don't actually use them that much anymore. We used to, and they did really well for us, but nowadays things are a lot simpler. So that's really important. There's a lot of value in doing your budget in looking at that. What I'm going to do...
Hence, we're no longer paying for a fax machine. Yeah.
Thanks, Leon. What I'm going to do, I've set some figures up in that screen there. So I've done my estimate budget figures in one screen, and I've just dragged it off screen because I want to show you how to actually get to the screen to set your budget up. So you come into accounting and reports. And one thing to be aware of in Xero, just in case you're not, is when you come into reports, there's little blue stars between some things, so beside some things. They're the things that appear in here on this drop-down menu. So if there's reports that you might want to be able to find easily, just put a little star beside them, and then they'll appear up on that drop-down menu every time you go into Xero. If you decide you don't use them anymore, you can just click on the star again and it's gone. So we're going to go into the budget manager. That's the place where your budgeting input and setup happens. So this is what this dummy file has in for its budget at the moment. So it's a bit clunky, you can take this screen and you can go and manually just change these numbers here if you want to. I find if you're looking to set up your budget initially or do it for the year, you're better off to do an import of your data and manipulate the data outside in Excel, because you can look at the higher level and you're less prone to data keying errors. If you've done your budget and you're going in and something's changed in your business and you want to change your budget on the fly, then definitely come in here. You can add the numbers on individual months per line item. You can also do fun things like saying we're going to have cost of goods sold here now, and we're going to take this little green arrow and click that, and then we can apply a fixed amount. So we can say there's $200 a month every month on from that point, or we can increase it by plus 10, or we can increase it by a fixed percentage. So I've just done by plus 10 on there, and so you can hit save on that. But what I'll do, I want to take my figures I exported from my profit and loss and manipulated and get them into a template to import back in again. So I need to hit export. CSV is the key thing. If you want to import anything into Xero, it needs to be in a CSV file. So I'm going to bring in my CSV, which will open somewhere. Oh, here we are. So the joys of using a CSV file is you've got very raw, unformatted data you need to work with. So I've got my profit and loss is in a better format, but the data I need to import in is pretty ordinary. What I'm going to do is I'm going to insert some cells. I'm going to get up the column width, just so I can get them back. So one of the challenges you get when you export a nicely presented report like the profit and loss from Xero is it puts the newest data on the left, but this budget report import puts the newest data on the right. So we need to just get some column headers sorted. So I'm just very quickly going to do this so that we get some headers, because the secret of using these import templates is, see how there's an asterisk at the top of account field, and these columns here are what it's going to import. So it doesn't matter too much what order the columns are in when you import, but the data in them will matter otherwise. So I'm going to just pull that back. So some of these months are really weird, but my data set is also weird. So I've got April, May, June 23, which I probably don't need. I'll replace July, August, September, and then I'm going to take my other data here. Now, one of the challenges you get with these imports is this report's only showing it's only showing data where you've actually got data. So that's a challenge. So I'm going to do a copy, and that's going to be for sales, but I'm going to paste I need to get it so that it's just the values. So I'll do a format, paste here to here. So see, that's with a CSV file. If you want to import it and you've got commas in your data, that'll break it. So you don't want that. And then I will copy my other data here. I don't want totals and things like that because I don't need that. And I'm going to paste this lot. I'm just going to start down here. Now I recognize it's not the right account numbers or anything, but Chris didn't give me enough time to do a proper example with this, so I'm just going to use very raw data. So I'm going to save this. So you can leave it open once you've saved it, because often when you're importing data like this, you'll need to manipulate it again. And I come back into Xero and I do an import. Now I don't need to download the template, but the template is there if you want to download the template data to use. I'm going to import. This is where I've saved it. This is the data set I just used. And then I will confirm that. So this is my data. You can see there's some sales data there. There's some other data there in July. August has some data. So I'll save that. So that's great. We've imported our data in. Like I said at the start, this is very unsophisticated and very quickly done. What you want to do then to look at that. So the important thing with this is, yes, you want to do the exercise at the start to set your forecast, set your budget, but the monitoring is actually the bit that matters. So you want to look at a budget variance report, which was one of the ones that I started earlier. So the budget variance report compares your profit and loss data for the month that you've selected with your budget. So at the moment, this is looking at the August data in this Xero file. So we've got 20 odd thousand of sales. Our budget was 5. So it's giving us a nice variance figure in dollars. It's giving us a variance in percentage. And it's giving us a year-to-date variance as well. So we can see what the year-to-date budget was for that account. And we can see a dollars and percentage variance. And that runs all the way down. And if we want to look at that and go, all right, hang on, we said we were going to have a $5,000 budget and we've had $20,000 of sales, you can right click on that data, look at your new tab, it will drill down into all of those transactions for that month. So you can see what happened that was different to your budget. So you can actually interrogate your real data. It won't let you interrogate your assumptions in your budget. So you've got to make sure you've got those budget assumptions specified somewhere when you're doing your forecasting, but it will give you those differences there. So a couple of other things to remember. I've talked through how to update those budget numbers on the fly. So I know I had a client last financial year, they changed their premises. They went through one of those step-up points that Leon talked about in their business, and their rent increased quite a bit. So we increased their rent budget from what it was originally. And another thing to consider is you can actually set up multiple budgets within Xero. So this is just showing us an overall budget. What you can actually do is you can export your current budget from here as a CSV file, edit it. So you might want to do a stretch budget, for example, for your business of what it might look like if you try and do really well and achieve some massive sales targets, what that might look like and what extra costs you might have in doing that. And then you will actually have those other budgets showing here. And you can run those budget variance reports with your different budget models you've got set up in them. So I think I'll end the live demo now and throw this to questions. And once I work out how to stop sharing the screen, or if someone else kills it for me.
Just while you're doing that, Dale, I might just jump in quickly, if I may. Just when you mentioned that point in time where it's one of those step-up points, that's where again you've got your profitability percentage in there as part of your forecast. So you're not stressing when you go, whoa, what's happening with my profitability? And you know that it's coming, you know that it's happening, and it allows you to plan for all those different steps. It's exactly as Leon said, it's about aligning everything to the bigger picture and not focusing on the smaller small detail needs to be focused on, but understanding the smaller detail, I suppose, is key.
Very true, Chris.
I know that was an an educational experience there for people, but the idea of that is showing how quickly and easily, what Dale was able to put together in 10 minutes there shows how quick and easy, and the lack of difficulty in putting a budget together, that people shouldn't be scared of it. The last report you had up there, the budget versus actual, I think is the most important report that anyone will look at in their business. If you've got a good budget and you're looking at that every month and seeing how you're going. I see David Clouts on here, an insolvency practitioner. If everyone did that, David wouldn't be here, he'd be out of a job, he'd be retired.
That's true, very true.
It is true. It's a bit like if you've ever had to steer a boat or a ship around, you find that at the tiniest little change of course, you start to go over there, and then you correct it. And looking at that report, budget versus actual, gives you the opportunity to identify that you are going off course and make that correction. So if you can look at that even each month is probably the right frequency, then it gives you the chance to make those corrections and keep heading towards where you're actually going to, rather than over here.
Okay. Questions just come from going, should we put a contingency amount for our budget for unseen expenses that come up or not? Yes, Jane, I think we always should. And look, we all go into start of year when we do our budgets, ideally, and then that we will come up with something else that we want to do throughout the year. So there always should be a contingency. And as I said, like in property development, they will have just a contingency line of 20% that the banks want to see to make sure we profit after that. There's two ways, as I said, you can do it. You can build it into each individual expense line or income line. Or the other option that Dale was demonstrating there as well, some people do a contingency budget in a different way. They will have, what if my income was 10% less and my expenses stayed the same, for argument's sake? Or what if my income was 10% less and my expenses were 10% higher? And look at contingencies and having alternate budgets as well if you want to have that. So there's multiple ways to put contingencies in there, but I would always recommend building contingencies of some sort into every budget.
And so sometimes, just to add to that, there's some areas where you're more likely to need contingencies than others. So something like for a business without a lot of physical assets, but you have an office, your repairs and maintenance is something you probably don't have a lot of. You're not gonna have a lot of, and you're not gonna have a specific timing for it, but there'll be something. So you chuck a monthly amount in there into your budget, and maybe over the year that gets used up. Other areas you might have your technology, you might have some extra budget space in that one for potential IT challenges and or opportunities. And the same thing in terms of your sales and marketing budget. You don't know what projects and campaigns that you're going to launch 12 months out, but you're going to need a buffer there for spending for that. So you build it into your budget without a project in mind for it.
In these days, there's also what I'd call there's some contingency budgeting that you might always include. And those of us that carry debtors, we always have a contingency amount there for bad debt write-off. You hope you'll never have it. And unfortunately, you always do have some. The other one in these days is, Lisa, I see you in the childcare industry, we've been plagued with it for the moment, is recruitment costs. We've had labour shortages, so no one ever thinks we want to put recruiters costs in there, but you've got to allow for it. So that's also another way to put contingencies in. Think of hypotheticals that might occur and provide for them. Any more? There's another item in the chat line there.
Just while you're looking there, Leon, I might just very quickly. You mentioned a couple of times that it's a living, breathing document. I think, just personally, I think that's very important for business owners and people to keep in mind when they're working on their own budget and when they're setting their own budget. Also for the users of that information. So for us, for example, we're very transparent with our team as to what individual budgets are for the period, and we also have a whole of team meeting where we convey how we're tracking against budget, because it's always good to celebrate a win. If you've had something happen in your business that means that your old budget is no longer relevant, then it's just insanity to just keep using the same one. It makes absolute sense just to update it to be relevant moving forwards. It's essentially, it's only relevant as of the last day that you did it. So I'll say that, firmly believing it, but I will issue a word of caution in that if you're constantly changing the goalposts, it's easier to stray off target. So I'm a firm believer that the budget should be a living, breathing document, but just be mindful if you're making a change to it, just be mindful that it does still line up with that end goal and all those things that we spoke about. Like the change would be because of a particular specific event, I would imagine, or a specific reason that's had a flow-on effect. It wouldn't just be changing it to celebrate a yay, we made budget.
Because keeping yourself accountable,
that's exactly right.
to that, right? Yeah. Rather than changing it to meet what actually happened, so that you feel good.
Yeah, that's it. Yep.
So there's two other questions here. Sharon Musker, thank you. How do you split up the budget for subscriptions, e.g. fixed versus variable? There's a couple of ways to do it. The one I would do it, Sharon, is I'd put subscriptions and I'd put fixed, so the ones I know, and have a line for that, so you know that one's there. And then, like I was talking about the others, it's sort of like a contingency that I would run those through as well. I think I'll have these other ones come up and put that an estimate of that with the document how I've come up with the basis of that assumption. There's also another thing that may come up, and Dale, feel free to correct me on this. But we get caught with a lot of our software subscriptions, etc., that has variability because they're in US dollars, and you might have another one to say that they're in foreign currency and set it up, and then you can adjust the exchange rate for those foreign currency transactions, which will update that as you go through. Chris or Dale, any thoughts on that one?
Yeah, I think as well, subscriptions are a funny one because you're normally signing up for something and you're committing to a dollar cost, but it might change. We find we put a chunk of our subscriptions up into the cost of sales section of our profit and loss. So like our zero subscriptions, because we have that for, it's a core cost of doing our business. If we didn't have it, we wouldn't have the revenue there. So we put that up there, but a lot of the others come down under the overhead costs. But in terms of whether they're partly variable and partly fixed, sometimes that's a real challenge. We have some that are like that, and depending on the quantum of the cost, sometimes you just have to grin and bear it, because the time it would take to have to manually split that out each invoice you receive isn't worth the benefit that you receive. So you have to make a judgment call on those ones.
Can I just add to that? Everything that you're looking to add still needs to have a level of sensibility about it. And Sharon, no offense to your question by any stretch, I know this wasn't what you were asking, but coming back to your question, I would take a very common sense approach to it, in that if you know that there's a fixed component, by all means split that out, maybe yourself in a separate sheet, split it out and say, right, well, this is definitely fixed. And if there's a component that is variable, maybe just take a moment to consider, well, what's that variable component linked to? Is it going to be linked to sales? Is it worthwhile me just doing a quick calc on how that's going to move each month for the period? And if it's easy enough to do, then by all means do it. If it gets in the too hard, too fast box, this is for yourself. We don't have a choice if we need to do something, but if it gets in the too hard, too fast box, by all means, just park it and say, well, it's good enough for what I'm after. And you can just monitor it on how you're going. And if it needs to be tweaked in the future, by all means, tweak it.
Okay, there's one other question here as well. We're getting close on time from, hope I've got this pronunciation right, but Pancash, how do I split up the budget? No, that's Sharon. Sorry. What's the best way to sales forecast for a new business? Not a really easy question to answer that one, but it comes back to what I was saying at the beginning. For a brand new business where you're starting out, you look at whether there's some data on historical other business that your competitors or something like that, or your previous experience, you might be for want of a better word, copying, that you've got a reasonable basis to copy off. The key thing to anything like that is, and those I've been a venture capitalist and I've funded a lot of startup business in the past, is have detailed assumptions of how you arrived at that. So, and it's a bit like Chris was talking about with the sales funnel. Well, I'm going to make 300 phone meetings a month, and I have a conversion rate of 20%, something along those lines. So this is what I expect to do, and this is the basis of it, and really flows through on a detailed assumption model that cascades down on how you would get to that. If you're a new disruptive business, it's almost going to be impossible. You've got no benchmark, so that's probably the best you can fall back on. But it really comes to industry knowledge and looking at what you can find and building on data from that to come up with your assumptions.
Known costs, just whatever's known, you factor those in and then make sensible assumptions about the rest.
Now, I'm mindful now that we're at 1:58, so we're pretty well at end of time. And yes, thank you, Sharon. We've done our minutes. Just a couple of things to close off to try and get out on time. First off, there will be a survey coming out just on that. Please also add if you've got any other suggestions. Obviously, there was no slides today, but there will be a recording. So if you want to refer back, you can do that. If you've got technical questions about how to complete a budget out of zero or that, don't talk to me, talk to Dale. We have another event coming up in October, which is a specialist one around self-managed super funds, which will be going out just to our self-managed super fund clients. So if that's you, you will be in touch shortly about that. For today's, there was an incentive for people to come along today. There was a lucky door prize, a free mini business planning session, which was valued at $2,750. Prior to starting the meeting today, we with the support from Meredith and Natasha from Outsourced to Us, we did a lucky hat draw, and we drew a name out of the hat from all the attendees. And now my mouse will not move. And it was Sasha. I'm just trying to get the surname right. Sasha Miller. Congratulations, Sasha. We'll be in touch with you to talk about how we can do a mini business planning session for you.
Hold on, Sasha. WBP Advisory Group, they do property valuations. So Ray and I know Sasha from A-File Business Group. So
I think Sasha's dropped off.
She has left in the last few minutes, yes.
Oh, okay. Well, I think we'll stick with the prize winner because we can't draw the hat again. We threw the names in the bin. So congratulations, Sasha. Thank you, everyone, for your attendance. We'll see you in October or before, and appreciate your input and feedback. Thanks for coming along.
Thanks very much, everyone.
Thanks, everyone.